Thanks for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of the top tech of HCL Technologies. The MD and CEO, Vijayakumar, and Prateek Aggarwal, the CFO, join in to talk about how the quarter went by, yes, but we usually don't like talking about just what's happening in the immediate quarter. The long-term trends from a large Nifty company are probably more important, and that's what we'll try and dwell on. Gentlemen, both of you, thank you so much for joining in. Prateek, to you, good morning, and CVK to you, good evening. Can I start with you, CVK? And
good morning, Neeraj. Good to
talk about how you thought. Some takeaways from the third quarter, because the headline is that it's been a third straight soft quarter, so to say, by the standards that you set as well. You would agree that it's maybe a quarter which is yet again been a bit softer than what people would have anticipated. What is leading you to having to play the waiting game, if I may ask?
Yeah. So Neeraj, I would agree with you. Overall numbers, revenue numbers was a little softer than what the street was expecting. But I think the devil is in the details. So if you look at our services business, which grew 5.2% sequentially, this is a very, very smart growth. And all of this growth has come organically. That's equally important to highlight. And year on year, it is 13.1%. I think our product business is a relatively new business. So we had a few deals in the end of the quarter which slipped. And in product business, there is a lot of revenue which needs to be converted in the same quarter because you sell new licenses. And when you sell new licenses, that gets converted to revenue in the same quarter, a very large part. So even if a few deals slip, then the revenue moves to the next quarter. So it's a blip, and this product team has done very well overall as a segment. We've done well over the last 9 quarters of the product and platform business in existence. This quarter was a blip, and I'm sure we'll catch up. We'll rebound very smartly in O&D. I think there are several very important highlights of the last quarter. Our bookings again was $2.3 billion, which is largely services. So our momentum on services continues. 14 large wins, and we added 11,135 people. This is the highest ever net addition in a quarter for us. So the momentum on hiring, of course, 5,500 plus of them are freshers because you don't really have a lot of lateral talent to hire. So you have to hire fresh talent, train them and groom them. So that's another highlight. And again, the icing on the top of the cake is we formally announced a payout policy where at least 75% of our net income will be paid out to our shareholders. And this is for a cumulative 5-year period. And this is something I think a lot of investors and analysts have been asking us. And we are glad that we could formally come out with a policy which I think a lot of our investors have liked.
And no, that is very impressive. I was going to come to that, CVK, because a lot of people, a lot of reports, a lot of analysts that I spoke to post Thursday evening have been enthused by that. So I'll come to that in a bit. Just a couple of other details before we get to those numbers as well. You had hinted at a strong Q2 for order inflows. They look very strong. As you said, largely services led, and 13 new deals, I believe, in the services segment. Is this an indication of a continued momentum maybe for Q3 and Q4 as well? Or do you believe that it's difficult to pencil that in, because you had over 3 billion in Q4, then Q1 was a bit so is it going to be a bit lumpy is the question?
See, Q4 was an outlier. We had a very large number of deal wins, which was the highest ever booking. I'm not sure, but we do have pipeline. We are hoping to do well in the next 2 quarters. But I think if you compare FY21 and FY22, I do believe the total booking will be it will grow impressively. That's what we expect based on the pipeline that we have.
Okay. And just one quick follow-up, CVK, before I get in Prateek as well. This platforms business, do you reckon the and it's okay, because I think that's what people are penciling in, that the real kicker of growth will probably not happen in H2 FY22, will bounce back in FY23. Again, is it an assumption on people's part, or do you reckon that it's safe to assume that let's not look at FY22 too closely for the platforms business, we can look at FY23?
No, we have, in fact, earlier we said a low single-digit growth in FY22. Based on the last quarter performance, we are saying it'll be 0 to 1%. So it'll be flat to 1% growth. That's what we expect for the product business. And by all the initiatives that we've taken, we think it'll get better in 23.
Okay, fair call. Prateek, pandemic spending had hit margins in Q1. Is this margin softness, though it is in the band that you had guided, you had specifically told me that you will maintain between 19 and 21, and it could be at the lower end or the higher end, depends on us every quarter. But is this softness, if you will, largely on account of the revenue miss, or did wage hikes also have a part to play? And Q3 being a quarter which typically is marred by furloughs, etc., what is the indication that you can give for Q3 as a result of what's happened in Q2 on the margin front?
Sure, Neeraj. So first of all, the revenue miss in PNP obviously flew down to the margin also. So that's just natural. I mean, especially because it is license revenue, it pretty much most of it flows down to margins. But the September quarter was also affected because we gave the first round of increments for the year, and we had given our last one in October last year actually, and this time we came back to the normal cycle of July to September quarter being the first round, and then the second round is following in this quarter, October to December. So that's our normal cycle. So that virtually replaced, the costs, the pandemic costs that we had in the June quarter. So it was almost like close to one-on-one match. So yes, that was a factor, but we will have some more of that factor coming in this quarter. We don't give quarterly guidance on the margins, so I won't answer your specific question on that, but content to say that for the full year we remain confident that we will hit the overall margin guidance of 19 to 21.
Okay, which is more than welcome. Now the strong suit, as I think CVK referred to as well, Prateek, was you guys raising the minimum dividend payout to 75% cumulatively over this FY22 to 26 thing. Now my question is this: the presumption as a result of this move is that HCL Tech will not actively look at very large M&A, and this move will help boost ROEs quite significantly, both of which could drive a re-rating of sorts. Not that you need re-rating, but a re-rating of sorts. What are your thoughts on this, the move and the implications that the street believes the move indicates?
Yeah, so that's, first of all, I must say that's a very perceptive question. And frankly, we are just listening very hard to our shareholders, our existing shareholders, or potential shareholders wanting to take a stake. For a long time, several quarters now, this has been the most frequently asked question, and we have listened carefully to that and made amends to our policy. Yes, to a large extent, it does mean that we are not going to be looking at those big bang billion-dollar kind of acquisitions. The last one actually we did was announced in December 2018 and closed in June 2019. So we haven't done any of that in the last more than 2 years now, 2.5 years actually. And the only one we did was a small acquisition in Australia, which was just about 150 million. So yes, it does indicate that, but it's more of listening to shareholders, like I said.
No, and it's a fantastic move.
I hope they appreciate this. this.
No, I'm pretty certain people will. I spoke to, as I said, some analysts, some shareholders, and everybody seemed pretty enthused by this happening. Some of them anticipated you guys to do it, to be honest, and therefore they said that this is an expectation that has come out to be true. So this quarter actually, save for the platform's miss, has largely been on tick, and the margins miss has been largely been on tick on a lot of counts, which I think CVK referred to as well. CVK, can I actually talk about one more aspect, and then I want an industry facing aspect before we wrap up this conversation.
Sure.
Attrition. Hitherto, you guys have managed it really well. This quarter has shown a bit of an uptick for you as well. Nowhere close to what your other peer groups have, but still a bit of an uptick. How serious is this issue? And some people that I speak to in the smaller companies say that this cyclical, it typically comes in, will last for 2-3 quarters and then ebb. Is it possible to kind of second guess that?
Yeah, Neeraj, though we have managed it quite well, and our attrition compared to the peer group is definitely much lower. But it is definitely the inching up of attrition on an LTM basis. It has gone up to 15.7%. It's definitely a concern, and we are absolutely focused on employee engagement. And the most important thing is training, upskilling. Of course, we need to recognize when people acquire niche skills, then they need to be specially compensated for that. We've given them good increments. So everything that we can do, we are doing to keep our employees happy. And I think we're managing it well, though it's a challenge. I also see it as a big opportunity where our employee value proposition can be a lot more fine-tuned and targeted to meet the employee aspirations.
By the way, the belief is that the way you guys are hiring, it is indicating what is in store ahead, because you are hiring a lot more than what people believe your current needs might be, and therefore the belief is that you guys might be believing or seeing the future pipeline of deals being very, very strong. Safe assumption, or is the street reading too much?
No, I think, see, there's only one thing. Like on freshers, you can hire a little bit in advance. And we have a certain number. We plan to do 22,000 freshers. And that's a significant uptick from last year. I think it's to do with the attrition, demand, and all of that combined is what is driving the increased hiring.
Okay. My final question, we are very close to the stipulated time, and either of you or both of you can answer, but there is a belief that only 20-25% of the global 3,000 infrastructure has likely moved to cloud, with another 60% likely to move over the next 3 to 5 years. And you guys, HCL Tech, has the largest leverage to this opportunity with what is estimated to be nearly a 28 to 30% revenue exposure. Could you comment a bit on this and whether these assumptions are correct, and how they could unravel over the next 3 to 5 years for you?
I think on a ballpark, 30% of the infrastructure has moved to public cloud, which is a fairly reasonable estimate. And this momentum is increasing. Maybe in the next few years, this will really go up, and a very large part of the infrastructure could be in public cloud. Some large customers are still pursuing a private cloud strategy as well. So this trend is going to be very good for us because we have a very large infrastructure business. A lot of the data centers and servers will migrate to cloud, and that gives us the opportunity for migration, operations, and in many cases, transforming their application landscape to really work very efficiently in a public cloud environment. So we see it as a good tailwind for our business.
Okay. Prateek, you want to quickly add to that before we wrap up?
No. CVK.
Okay. Very cool. Thank you. CVK did the job well. Okay, gentlemen, really appreciate you taking the time out and speaking to us today on BloombergQuint. A few moves done, and hope they help in the quarters ahead. Thank you for taking the time out.
Thank you, Neeraj.
And viewers, thanks for tuning in.